Welcome to the Deep Dive. This week, we're taking a close look at what's been happening in African transportation.
Yeah, we're pulling insights directly from a pretty comprehensive weekly analysis report. This one covers June 2nd through the 9th, 2025.
And it gives us a snapshot across all the key areas, doesn't it? Road, rail, aviation, maritime.
Right, and it also zooms in on that crucial question of funding. How do these massive projects actually get paid for on the continent?
Our mission, really, is to unpack the most important findings from this particular week. We want to help you cut through the noise, understand the maybe surprising facts,
and get a clear picture of what's truly driving progress and, well, what challenges are still there in Africa's transport sector this week.
We're definitely seeing some big strategic moves, particularly in ports and rail.
But also some familiar, let's say, struggles in aviation and road transport.
And there's this really thought-provoking perspective on how Africa might, fund its own future infrastructure. That one jumped out at me.
Okay, let's dive in then. The report kicks off with an executive summary, sort of the high-level view.
Right.
And it highlights a few themes that seem to run across all the sectors this week. First up, this concerted effort towards formalization and modernization.
Yes, trying to bring operations into line with more, let's say, established or efficient practices.
And linked to that, the report notes a notable surge in private sector interest in infrastructure.
That's a really significant signal, isn't it? Seeing that private money potentially coming in.
It is. But, contrasting with that positive momentum, there are these persistent financial challenges in certain areas. We definitely need to talk about those.
Absolutely.
And kind of woven through it all are these strategic initiatives aimed specifically at bolstering trade capacity across Africa.
So it's not a simple picture. It's a continent pushing hard, trying to upgrade its networks for growth and integration.
But doing so while navigating some really deep-seated structural issues and, frankly, financial hurdles.
The report points to specific examples just from this week that show this mix. South Africa's ongoing efforts with taxi formalization.
That persistent problem of blocked airline funds.
That major development, MSC, deploying those huge container ships to West Africa.
Right, the ULCVs.
Strategic port expansions, like NATO Westmed in Morocco, Matola in Mozambique.
That surprising level of private sector interest in South African rail? Oh, we have to unpack that one.
Definitely. And maybe most interestingly, that pivotal new report from the Africa Finance Corporation, the AFC, on the potential of domestic capital.
Yeah, it's a dynamic mix. Really shows both the ambition and the practical realities on the ground.
Okay, let's start with one of those stark realities then, road transport. Specifically, the situation with South Africa's minibus taxi industry. The report emphasizes just how central this industry is.
Oh, absolutely critical. I mean, it's the dominant mode, moving nearly 80% of commuters in South Africa.
80%?
And it's entirely black-owned, plays this massive socioeconomic role for so many families.
Yet it's so often in the headlines for, safety concerns and, unfortunately, violence.
Yeah, the report highlights concerns voiced by South Africa's transport minister just around June 9th. Real apprehension over the continued failure to formalize the industry.
And bring operations in line with what he called normal competitive business practices.
And the stats are just grim. The report mentions the killing of 4 people at a taxi rank in the Western Cape the week before, linked to route disputes between CATA and CODETA. Those are rival associations.
And it notes, I saw this, 59 deaths linked just to taxi violence this year alone.
59. It's deeply worrying.
That number is just shocking. The minister directly connects this lack of formalization to the industry being, quote, in disrepute and a danger to commuters.
And the source reminds us of the history here, where deregulation in the past, ironically, kind of contributed to the conditions that allow this violence to persist.
So formalization isn't just paperwork, is it? The report presents it as fundamentally linked to safety and stability.
Exactly. The minister's call for deeper structural reform, better oversight, and collaborative problem-solving really acknowledges that complexity. It's about balancing regulation with the economic realities.
And getting at the roots of the conflict.
Right. It's a tough needle to thread.
So, given all that pressure, the violence, what's the industry itself saying? What about Sanaco, the main body?
Well, Sanaco admitted that reform has been, let's say, slow since that big 2020 national forum, the Lekgotla, which was aimed at professionalizing things.
Okay, so acknowledging the slow pace.
Mm-hmm.
But are they doing anything?
They did highlight some initiatives, things like road safety programs, putting security at ranks, training for drivers and marshals,
Practical steps.
and also trying to push automated fare collection systems, and interestingly, a shift towards forming cooperatives instead of just individual operators competing so fiercely.
Cooperatives. Why that model? What's the thinking?
The idea, as I understand it, is to move towards a structure where drivers might get salaries, benefits, which helps with tax compliance. And maybe crucially, to diversify revenue streams. They're exploring things like selling lubricants, fuel, parts directly to operators.
So trying to reduce the dependency on just the route revenue, which is where the disputes often flare up.
Exactly, trying to mitigate one of the primary drivers of conflict.
It sounds like the industry is maybe trying to transform from within, perhaps seeing stricter government intervention coming if they don't.
It could be. It shows a recognition that they need to adapt for long-term sustainability. But, making fundamental changes in such a vast, largely informal sector, it's incredibly challenging.
It's definitely a delicate balance, isn't it? Ensuring public safety while supporting the livelihoods tied to this, well, vital but clearly troubled industry.
Absolutely.
Okay, moving from the roads to the skies. The aviation sector this week, it seems like a bit of a turbulent picture, especially with one persistent issue.
Oh.
Blocked airline funds.
Yeah. This is a major headache for airlines operating across Africa. IAT, the International Air Transport Association, they reported on June 6th that as of April 2025, about $1.3 billion in airline revenues were blocked globally.
Okay, $1.3 billion globally. Is that getting better or worse?
It's actually an improvement from late 2024 when it was $1.7 billion, but here's the kicker. 10 countries account for 80% of that total. That's over $1 billion, $1.03 billion to be exact. And the vast majority of those countries are right here in Africa.
Wow, okay. So the problem is really concentrated. Which countries are we talking about?
The report lists the top African ones. Mozambique leads with $205 million, citing liquidity issues. Then the Central African Franc Zone countries, that's Cameroon, CIR, Chad, Republic of Congo, Equatorial Guinea, Gabon collectively holding $191 million due to foreign exchange restrictions.
Yep.
Algeria's got $178 million blocked. Angola, $84 million. Eritrea, $76 million. Zimbabwe, $68 million. And Ethiopia, $44 million. Mostly those foreign exchange issues.
What does this actually do to the airlines? It sounds bad, but what's the real impact?
It's debilitating. It's not just an accounting problem. Airlines earn money in local currency, right? But they're big costs. Fuel, maintenance, leasing the planes, those are usually priced in dollars. So when they can't get their earnings out, converted to dollars.
They can't pay their bills.
Exactly. It starves them of the hard currency they need to operate. It threatens their sustainability, jeopardizes connectivity. The report even reminds us how Emirates had to suspend flights to Nigeria back in 2022 because of this exact issue.
So it's like a major non-tariff barrier, effectively, hindering growth, tourism, trade, and completely at odds with goals like the single African air transport market.
Precisely. And while the global total has come down a bit, the heavy concentration in these specific African countries really highlights some underlying economic vulnerabilities, mostly around dollar liquidity and maybe weaknesses in the financial systems.
Is there any hope? Can countries fix this?
Well, the fact that Nigeria managed to clear a massive backlog, like $831 million, shows that, yes, resolution is possible, but it takes concerted action by governments and central banks working together.
So it's not just an aviation problem, it's a macroeconomic one.
Fundamentally, yes. The root causes often lie outside the aviation authority's direct control. Long-term solutions probably need regional bodies, development finance institutions getting involved too.
Okay, so blocked funds remain a huge challenge. What else was happening in aviation this week, according to the report?
Yeah, it was a real mixed bag of other news. Operationally, Air Côte d'Ivoire suspended its Abidjan-Johannesburg service from June 5th. Perhaps more significantly, Tanzania was added to the EU air safety list on June 9th due to safety deficiencies identified.
Ouch. That's a serious blow, isn't it? Potential impact on tourism, access to Europe.
Definitely a setback. On a more positive note, Ethiopian Airlines celebrated 50 years of continuous service to Kigali, Rwanda.
50 years?
Yeah.
That's impressive. Highlights those key intra-African routes.
It does. Elsewhere, Corsair indicated consolidation as part of its growth strategy. Viva Jets got its Air Operator Certificate, its AOC, in Nigeria that opens up business aviation opportunities.
Okay, new players entering.
Namibia enhanced its air defense with transport aircraft from China. Shows aviation's other roles. Air BP and Sonangol in Angola announced a technical services agreement for aviation fuel supply in West Africa, important infrastructure bid.
Right. Fuel is key.
And IATA reiterated its commitment to the net zero 2050 emissions target, despite ongoing concerns about sustainable aviation fuel its availability and cost.
Still pushing on the green front. And an award, too.
Yeah, Mesfin Tasso, the CEO of Ethiopian, is set to receive a Lifetime Achievement Award.
So yeah, a really varied landscape in aviation this week. Progress, anniversaries, new ventures.
But alongside these really significant systemic challenges like the blocked funds and, safety list inclusions, it's definitely not a uniform story across the continent's skies.
Okay, let's shift now to the maritime sector and ports. Here, the story seems much more focused on scaling up, getting ready for more trade.
Yeah, this is where we saw maybe the most visually striking development of the week. MSC, the shipping giant, deploying these 24,000 TEU ultra-large container vessels, ULCVs, to West Africa.
24,000 TEUs. That's 20-foot equivalent units, right? The standard container size.
That's the one. And these behemoths, ships like the MSC Deleta, the MSC Turkey, they started calling at ports in Ghana, Togo, Cote d'Ivoire, Cameroon in early June on the Asia-West Africa service.
Wow, a 24,000 TEU ship calling in West Africa. That is absolutely massive. What's driving that? Just growing trade.
Fundamentally, yes. It's the burgeoning Asia-Africa trade lane. There's clear customer demand for more capacity, and MSC is obviously committing some serious assets here.
And the impacts must be huge.
Potentially enormous. It should boost trade volumes, but it absolutely necessitates further port upgrades to handle these giant ships efficiently. It could enhance efficiency overall, and it really positions key ports like Lomé, Abidjan, Tema, Kribi as major regional transshipment hubs.
So it's more than just a vote of confidence in the trade route. It's basically a demand signal. Upgrade your infrastructure if you want this business.
Exactly. It's a testament to the investments already made, dredging deeper channels, building longer quays, getting bigger cranes, but it puts immense pressure on ongoing enhancements.
And it's not just about the port itself, is it? What about getting the cargo out of the port?
That's the critical point the analysis makes. This move absolutely highlights the need for efficient feeder services to smaller regional ports, and even more importantly, for robust hinterland connectivity. We're talking effective rail links, good roads, maybe even waterways.
Otherwise, all those containers just pile up.
Right. You create a massive bottleneck inland. This could also lead to a kind of tiered port system, A few ports capable of handling ULCVs dominate, while others focus on feeder traffic or specific cargo types.
It's fascinating how putting bigger ships on the water can force investments hundreds of miles inland, potentially reshaping a whole region's economy. It's not just about the coastline.
Not at all. These ULCVs could be a catalyst for broader development, and it's a big but, only if they're coupled with serious coordinated investment in logistics corridors and those port-centric special economic zones, SEZs.
How does that work?
Well, lower per unit shipping costs can make African exports more competitive, reduce the cost of imports. That can attract foreign direct investment, especially if there are SEZs nearby offering incentives.
And the sheer volume forces improvements in cross-border transport.
It has to. Better cross-border road and rail networks become essential, which directly supports the goals of the African Continental Free Trade Area, the AfCFTA. But again, the risk is there if those complementary investments don't happen fast enough.
Okay, so big moves in West Africa. Did the report mention other strategic port developments elsewhere this week?
It did. Nador West Med in Morocco continues to develop as a major Mediterranean hub for both transshipment and, interestingly, energy. Yeah. There was news of a new partnership between TIL, which is an MSC subsidiary, and Marsa Maroc, the Moroccan port operator, for a big container terminal there. 3.4 million TEU capacity due early 2027. That follows an earlier deal with CMA CGM.
So more container capacity. Where does the energy part come in?
What's really forward-looking about Nador is its positioning for future green hydrogen bunkering.
Green hydrogen bunkering? You mean like refueling ships with new, cleaner, synthetic fuels made from green hydrogen?
Exactly that. They're aligning with global shipping's big push to decarbonize. It's a long-term play.
That's fascinating. Contrast that with what else was mentioned.
Well, contrast that with the Matola coal terminal down in Mozambique. Grindrod Limited just announced an $80 million expansion there this week.
Coal, so a very different focus. Future fuels versus very established traditional commodities.
Right. It really highlights the diverse national strategies and economic realities. Matola is doubling down on bulk commodity exports, which are still hugely important for Mozambique's economy.
And Egypt was mentioned too.
Yes, Egypt saw the arrival of another floating storage and regasification unit, an FSRU, called the Energos Eskimo around June 6th. This boosts its capacity to import liquefied natural gas, LNG, mainly for energy security.
So the maritime story this week is really diverse. North Africa looking at logistics and future green energy. Southern Africa focusing on current commodity strengths. Egypt securing its natural gas supply.
It really shows different regions playing to their strengths, planning for the future, but maybe with varying levels of alignment with those global energy transition trends we talked about.
Okay, let's shift gears again. Rail infrastructure. There seems to be some significant momentum here too, especially back in South Africa with investment interest.
Yeah, this is where that private sector interest theme really comes alive. South Africa's Department of Transport reported what they called unprecedented private sector interest.
Unprecedented.
That's the word they use. Interest in their request for information, the RFI, for rehabilitating and operating parts of the rail and port network. On June 5th, they announced they got a staggering 162 formal responses.
162. Responses to operate on rail networks that have faced, huge issues. Theft, vandalism, underinvestment, Transnet struggles. That does sound genuinely unprecedented.
It absolutely is, given the well-documented performance challenges. The RFI targeted specific, crucial corridors. The iron ore and manganese lines alone got 51 responses.
Wow.
The coal and chrome corridors, 48 responses, and the container and automotive corridors, 63 responses.
So, massive interest in the most critical freight lines.
Yeah.
What's driving this? Is it just the scale of the failure creating an opportunity?
It seems to be a direct response to that declining performance and the huge economic costs. The source mentioned mining potentially losing R1 billion per day due to poor logistics.
$1 billion rand a day.
Huge numbers. And the government clearly has limited resources. They can't fix it all alone.
They mentioned it might take until 2027 for new private trains to even be operational, though. So this is a long, complex process.
Oh, definitely. But that level of interest, despite Transnet's very public struggles with locomotive shortages and inefficiencies, it signals a strong belief in the market that significant efficiency gains are possible if the structure is right.
And the government seems to be acknowledging they need to create the right environment.
Yes, they're talking about an enabling environment, setting up a specialized public-private partnership or PPP unit. But look, turning RFI interest into actual trains running on tracks is incredibly complex.
What are the hurdles?
Meticulous negotiation, clarity on who handles security, who handles maintenance, transparent processes. And the report rightly reminds us of the history, those canceled CRRC locomotive contracts due to corruption allegations. That's a huge governance risk that needs careful watching.
So the potential upside is enormous, right? Better logistics for key industries like mining and auto, boosting competitiveness, shifting freight off congested roads, maybe lowering emissions.
Absolutely massive potential. But it also raises some really critical questions for you, the listener, to think about. How do you ensure equitable access for everyone, not just the big players? What will tariffs look like? Could private operators just cherry pick the profitable lines?
And what happens to Transnet, the state operator? Do they become just a landlord? A regulator? Do they still compete?
Exactly. Its future role is a huge question. The outcome of this whole private sector participation process will likely have big implications for how other state-owned enterprises are reformed in South Africa.
Now, regionally, the report also mentioned Mozambique actually commissioning new locomotives.
Yes, Mozambique commissioned its first CRRC diesel locomotives in early June. These ones are specifically for passenger services.
CRRC. That's the same Chinese supplier that South Africa had all those issues with.
The very same. It's quite an interesting contrast, isn't it? South Africa's relationship with CRRC is, well, extremely complicated due to those past disputes, the cancellations linked to corruption.
Right. I remember reading SA was having trouble even getting parts for the CRRC locos they already had.
Exactly. Reportedly relying on companies like Alstom just to maintain the existing fleet. So you have Mozambique commissioning new ones while SA is struggling with the old ones from the same supplier.
Why the difference, do you think? Is it just different deals, different circumstances?
It certainly suggests different experiences. Could be different procurement processes, different financing structures, maybe just different operational needs passenger versus heavy freight.
What does it mean for Mozambique going forward, using these new locos?
Well, it brings up the usual considerations. Ensuring proper technology transfer, building long-term maintenance capacity locally, and securing a reliable supply chain for spare parts down the line.
Okay, so all these discussions, roads, air, sea, rail, they all eventually circle back to one critical question. How do you pay for all this infrastructure?
And the report this week features a really significant, maybe even game-changing perspective on this.
This is the AFC report.
Yes, the Africa Finance Corporation. They released their State of Africa's Infrastructure 2025 report on June 5th, and it offers a potential paradigm shift.
Okay, what's the headline?
The headline finding is the identification of a staggering $4 trillion in potential domestic African savings that could, theoretically, be mobilized for infrastructure development.
$4 trillion with a T.
Yeah.
That's a mind-blowing number, especially when we always hear about the funding deficit in Africa. Where is this money supposedly sitting?
It's held in various places across the continent. The report breaks it down. Pension and retirement funds hold over $455 billion. Insurance firms, $320 billion. Public development banks, $250 billion. Sovereign wealth funds have $150 billion.
Okay, that's already substantial.
But wait, there's more. African central banks hold foreign currency reserves totaling $473 billion. Commercial banking assets are around $2.5 trillion, and the AFC says these are significantly underutilized for long-term projects.
$2.5 trillion in banks.
Plus, you've got diaspora remittances, money sent home by Africans living abroad. That was over $95 billion just in 2024, another largely untapped resource for investment.
So the core argument from the AFC isn't that Africa lacks money.
Exactly. It's not a fundamental lack of capital within Africa. The problem, they argue, is the lack of effective mechanisms to redirect that capital. Ways to channel it. A lot of this money is sitting in low-yield assets, often held outside the continent, instead of being invested in long-term domestic infrastructure projects where it's desperately needed.
So this completely challenges that traditional narrative, the one that says Africa has to rely mainly on external aid or foreign direct investment because of this huge funding gap.
It really does. I mean, yes, the estimated annual infrastructure need is huge, maybe $130, $170 billion a year. And yes, there's a reported shortfall, maybe $60 to $100 billion annually. But the AFC report presents this compelling counter-narrative. Substantial resources already exist within Africa.
The implication then is that the right policy reforms could unlock this massive potential.
That's the core idea. Strategic reforms focusing on strengthening domestic financial markets, maybe adjusting regulations for institutional investors like pension funds so they can invest more in long-term infrastructure.
And creating the right kind of investment vehicles, things that pension funds would actually feel comfortable putting money into.
Precisely. Creating suitable, perhaps de-risked investment vehicles is key. The AFC recommends strengthening domestic financial institutions, integrating regional capital markets. They mention initiatives like ASEA, the African Securities Exchanges Association, and AELP.
What's AELP?
The African Exchanges Linkage Project. Basically, connecting stock exchanges. They also suggest expanding the range of investment vehicles available and boosting financial inclusion to bring more savings into the formal system in the first place.
Wow. Mobilizing even a fraction of that $4 trillion.
Yeah.
It'd be absolutely transformative, wouldn't it?
Completely. It could create a virtuous cycle. Domestic investment generates domestic returns, which fuels growth, builds local capacity and expertise.
And it reduces reliance on external debt, with all the strings and foreign exchange risks attached.
Exactly. Reduces exposure to volatile exchange rates and the conditionalities that often come with external finance. It points towards greater economic sovereignty.
But it can't be that easy. What are the barriers? Why isn't this happening already if the money is there?
Oh, the barriers are significant, and the report acknowledges them. They're structural, they're regulatory. Arguably, there are even mindset issues.
Like what?
Things like restrictive regulations that limit how pension funds can invest, a perceived lack of genuinely bankable projects presented in a way that attracts long-term institutional capital, the perceived risk of long-term domestic ventures compared to, say, safer-seeming external investments.
Underdeveloped local capital markets, too, I imagine.
Definitely. And limited capacity in many public development banks to actually structure these complex deals. It requires a really coordinated effort involving governments, regulators, the private sector.
And that old problem of the Africa premium, paying higher borrowing costs.
That needs addressing, too. African entities often face higher borrowing costs than might be justified by actual default rates. So yes, big potential, but also significant hurdles to overcome.
That $4 trillion figure, though, and the whole focus on domestic mobilization, it really does offer a different lens to view the entire infrastructure challenge, doesn't it?
It certainly provides a more hopeful, potentially more self-reliant perspective if the right conditions and effective mechanisms can actually be put in place.
Okay, so let's try and pull all this together. Looking back at everything we've discussed from this week's analysis, what are the main themes, the dominant trends that emerge?
Well, you definitely see that push for formalization and modernization across different sectors, aiming for efficiency, safety.
But hitting those tough implementation challenges like we saw with the SA taxi industry.
Right. Then there's that clear increase in private sector appetite for infrastructure. The SA Rail RFI response is the big example there, and the AFC's focus on domestic capital ties into that too.
Acknowledging the need to look beyond just public funds, but requiring really robust PPP frameworks, transparency.
Absolutely. Then you have the persistence of financial constraints. Those blocked airline funds are a prime example, contrasting really sharply with that huge untapped domestic capital potential. It highlights a gap, doesn't it, between capital availability and its efficient movement and channeling.
Yeah, the plumbing isn't working right.
Kind of, and running through it all is that clear focus on strategic investments specifically aimed at enhancing trade, the ULCVs, the port expansions, targeting key rail corridors, all aligning with broader goals like FCFTA.
And what about the emerging opportunities that stood out this week?
The biggest, arguably, is that $4 trillion domestic capital potential. That's a potential paradigm shift if it can be unlocked.
Right.
Then you see niche aviation growth, like Viva Jets getting its license, the opportunity to develop those integrated port-centric economic zones, spurred by the ULCVs, and future-focused areas like green bunkering, which NATOR's Med is looking at.
But those opportunities exist alongside some pretty formidable lingering challenges.
Oh, absolutely. The deep-rooted issues in the informal sector, like the violence and slow reform in South Africa's taxi industry. Critical safety standards, starkly highlighted by Tanzania ending up on the EU air safety list.
Governance and anti-corruption risks are still there too, right? Thinking about those past rail contract issues.
Definitely still a factor. Ensuring that the benefits of these huge projects are distributed equitably is another challenge. And of course, underpinning everything is the sheer, vast, overall infrastructure deficit that still needs to be closed across the continent.
So this week's snapshot, it really paints a picture of African transportation in a very dynamic state. There's clear momentum, real ambition for modernization and expansion.
Driven by both public and private interest.
But constantly navigating and sometimes really held back by these significant deep-seated challenges.
Yeah, that core tension between the ambition and the often harsh reality is visible across every mode we talked about today.
And realizing Africa's transport potential, which is just so vital for hitting those bigger economic goals like FCFTA, it really hinges on getting the fundamentals right, doesn't it?
Addressing governance, ensuring financial stability, upholding safety standards, driving inclusive growth. It all has to come together.
And the potential game changer, based on that fascinating AFC report, seems to be the possibility of effectively unlocking and channeling that estimated $4 trillion in domestic capital.
Yeah, that could truly pave a more sustainable, more self-reliant path for the continent's infrastructure future.
It shifts the conversation, like you said, from where do we find the money
to how do we better use the money we collectively already have within the continent. It's a powerful shift in perspective.
So considering everything we've discussed, from those giant ships arriving in West Africa to the struggles of the taxi sector, the complexities of rail reform, and this immense potential of domestic capital, what piece of this incredibly complex African transportation puzzle stands out most to you, the listener? What do you think is the absolute key driver for change? The one thing that, if fixed or unlocked, could really accelerate everything else.
Something for you to mull over as you go about your week.
Definitely food for thought.
Yeah.
Thanks for diving deep with us this week.
We'll be back next week with another look at what's shaping the continent.